Should you prioritize capital growth or cash flow in your property investment portfolio? If your goal is financial freedom, retiring early, or building generational wealth, it is important to understand how these two strategies work and which one fits your goal the best. Hi, I'm Rahul and welcome back to Rahul Real Estate Insider. If you're new here, don't forget to hit the subscribe button. I share insights on real estate, wealth building, and financial freedom. I post fresh content regularly. If you're hungry for more, check me out on Instagram and TikTok. The links are in the description below. Okay, let's break this down. Imagine you have $800,000 to invest and you're looking at two different options, one in the city, one in the suburb. The one in the city is a high demand urban area that rents at about $3,000 a month. And the property is appreciating typically in the city at about 6% a year. Now, the other option is in the suburban areas where the property is renting at about $3,500 a month and appreciates at about 3% annually. Why is the suburban rent higher? You would ask. For this price, you're typically getting a larger house, maybe more bedrooms, a backyard that features attract more families who end up paying a bit more rent in these areas. At first glance, the suburban property seems like a winner with $42,000 of annual rent. But the real estate investing isn't about cash flow, it's about understanding the full picture. Cash flow is great because it keeps you afloat with regular incomes to cover your mortgage payments and the essentials, which is absolutely must. But on the other hand, capital growth builds you long-term wealth, the wealth that actually generates value in 10, 15, 20 years down the line. Here's how I like to explain it. Cash flow keeps you afloat. It helps you manage your day-to-day expenses. But capital growth accelerates your wealth, allowing you to scale and build something substantial. That's why the 6% appreciation rate over here helps you grow in the long term. Now let's see how these properties perform over time using the compounding growth method. Now, let's say 3-year example, the city property appreciating at 6% is now valued at $955,000 or so. City total growth from the original purchase price is sitting at close to $150,000 in just 3 years. Whereas the suburban growing at 3.5%, 4% would be sitting at $872,000, where the total growth is only $72,000. The difference between 3 years between a city and a suburban properties based on just the appreciation rate is $82,000. This is just in 3 years. Now take a look at 5 years down the line. The suburban property value is sitting at $927,000, whereas the city is sitting at over $1 million right now. The total difference in appreciation value in 5 years is at about $150,000. Now 10 years down the line, this difference increases to $389,000, almost $400,000 in property value difference, only considering a 3 and a 6% rate of growth. Sometimes the city becomes more volatile, or even the suburban, the rates can go up and down, but this difference is predominantly what causes you to grow faster and a much faster pace. So let me ask you, what's your goal in real estate? Is it passive income to help you with monthly expenses, retiring early, or building wealth that lasts generations? Now here's where capital growth really shines. It lets you leverage equity to buy more properties. For example, let's say your city property grows by $144,000 in 3 years. You can finance and pull out a portion of that equity, combine it with some of your own savings, and use it for down payment for your next property. You can either pull out $100,000 in equity or a bit more depending on the circumstances then, but this is how you can use this equity. Now, a lot of people get confused between pulling out equity and getting taxed on that. Now, you might think, isn't that income when you're pulling equity out of the property? Won't you be taxed on it? But here's the trick. In the eyes of the bank, the equity isn't the income. It's a debt, so you can't be taxed on the debt again. This is why capital growth is so powerful. It's not just about the value increase, it's about creating opportunities for your next move. Now, let's talk about some taxes. Cash flow properties, the rental income is taxed as a regular income. So if you're earning $42,000 a year in rent and you're in high tax bracket, a lot of it goes towards the taxes. Capital growth properties, the appreciation isn't taxed unless and until you sell the property. And even then, it's taxed at capital gains, which is much lower. Here's another tip. So some negative cash flow properties like certain condos in the GTA might cost you money upfront, but they're easy to manage and expect to see a big appreciation in the next 3 to 4 years. Positive cash flow can help you qualify for more loans because it shows the banks that you can handle the payments. But if your properties are not appreciating, you'll eventually hit a ceiling. You can't scale your portfolio if there's no value left in those properties. That's why capital growth properties takes the win. They build equity faster, which you can use to keep expanding, even if your cash flow is neutral or even slightly negative. Some investors get caught up chasing high cash flow from cheaper properties. But here's the problem. These properties often come with higher maintenance costs, unreliable tenants, and more stress. I call this buying yourself a job. Instead, focus on high growth areas, the neighborhoods which are easier to manage and then also help you grow value over time. Here's the bottom line. Cash flow keeps you afloat during challenging times, no doubt about it. But capital growth gets you ahead, helping you to scale and retire comfortably. If you're ready to invest smartly in Toronto or GTA, reach out to me or my team. We'll help you navigate the market, analyze the numbers, and build a portfolio that actually works for you. If this video gave you value, hit the like button and share it with someone who's ready to start their real estate journey. Don't forget to subscribe. I'll see you in the next one. Let's build wealth together.